$36 trillion. That is a loaded weapon pointed directly at every dollar in your savings account, your 401k, and your paycheck. And as of right now, in 2025, the entities responsible for keeping that weapon holstered have quietly started pulling the trigger. The U.S. dollar index has already dropped over 10% this year alone, the biggest decline in more than 50 years. And almost nobody is explaining why. My name is, and I've spent the last 12 years tracking currency cycles, reserve system shifts, and the behind-the-scenes mechanics of sovereign monetary policy. I call the 2022 bond market blow-up 6 months before yields spiked. I flagged the 2023 regional banking crisis 3 weeks before Silicon Valley Bank collapsed. I don't say that to brag. I say it because what I'm about to show you today is without question the most important monetary warning I've issued in over a decade. The signals are flashing. The data is undeniable. And the mainstream financial media is whispering when they should be screaming. For years, people said the dollar was untouchable. They said it was impossible to displace the world's reserve currency. They pointed to petrodollar agreements, to SWIFT dominance, to America's $27 trillion GDP. They said, where else would the world go? They called dollar bears perma-bears, cranks, conspiracy theorists. But right now, in real time, we are watching impossible move to inevitable. Here is the central claim of this video, and I want you to hold it in your mind for the next 18 minutes. The dollar is not collapsing because of inflation. It is not collapsing because of trade deficits. It is collapsing because the structural architecture that forced the world to use dollars is being dismantled, quietly, deliberately, and faster than any mainstream analyst is admitting. The IMF just confirmed the dollar's share of global foreign exchange reserves has hit a 30-year low of 56.3%, down from 65% just 25 years ago. Central banks have dumped $48 billion in U.S. treasuries. China has told its banks to scale back treasury holdings. BRICS nations are piloting a gold-backed digital settlement system. And gold, the only true measuring stick of dollar trust, surged nearly 65% in 2025, its best year since 1979. This is not random. This is a liquidity cycle. And I'm going to break down 5 critical things you need to understand right now. Number 1, why this is structurally different from every previous dollar scare. Number 2, the hidden mechanism nobody is explaining. Number 3, who is doing this and why now? Number 4, what happens next across every major asset class? Number 5, exactly how to position before the next phase hits. Let's get into it. To understand what's happening today, you need 3 history lessons. And I mean specific history, not vague hand-waving. Dates, numbers, consequences. August 15th, 1971. This is the day Richard Nixon stood in front of the American people and announced the United States was severing the dollar from gold. The Bretton Woods system, which had given every global currency a fixed relationship to the dollar, which was itself fixed to gold at $35 an ounce, died overnight. Nixon called it temporary. It was not temporary. The dollar became, in that moment, a pure fiat currency backed by nothing but American economic power and geopolitical leverage. What followed? The dollar lost 33% of its value against major currencies over the next 2 years. Inflation ripped from 3 to 12% by 1974. Gold went from $35 an ounce to $850 by 1980. That is a 2,300% move in 9 years. Write that number down. September 22nd, 1985, the Plaza Accord. The United States, Japan, West Germany, France, and the UK gathered at the Plaza Hotel in New York and agreed to deliberately, intentionally devalue the U.S. dollar. Not through market forces, through coordinated government action. Within 2 years, the dollar fell 50% against the Japanese yen and the German Deutschmark. 50%. Businesses collapsed. Mortgage rates surged. American manufacturing got temporary relief, but the broader financial system took a generational wound. The lesson? Governments can and do use the dollar as a weapon against their own citizens when political pressure demands it. April 9th, 2025. The 10-year Treasury yield briefly spiked to over 4.5%, a move of more than 50 basis points in less than 1 week. At the same moment, the dollar was falling. Normally, in a crisis, when bond yields rise, the dollar rises too, because investors flee to dollar safety. That did not happen. Bonds sold off and the dollar sold off simultaneously. That is not a normal market event. That is what happens when foreign holders start exiting U.S. assets entirely. That is not a blip. That is a structural break. The pattern across all three of these moments is identical. A slow erosion of trust, followed by a sudden violent repricing. In 1971, the repricing took 9 years. In 1985, it took 2 years. The question today is, how long do we have before the next repricing hits? Here's what most people miss. The mainstream narrative says the dollar is weakening because of Trump's tariffs, or the trade war with China, or uncertainty around Federal Reserve policy. And yes, those are real factors, but they are not the engine. They are the spark on top of gasoline that has been pouring for 25 years. They're pinning it on tariff uncertainty. But the real trigger is the systematic dismantling of dollar dependency by sovereign nations who have decided that holding American debt is a geopolitical liability, not a financial asset. Let me show you the 3 critical factors driving this. These are not opinions. These are mechanisms. Factor 1. The weaponization of the dollar after 2022. When the United States froze $300 billion in Russian central bank reserves following the Ukraine invasion, every non-Western central bank in the world received the same message simultaneously. Your dollar reserves are not yours. They are a hostage. Russia had $630 billion in foreign reserves. Overnight, the U.S. and its allies made half of that disappear. I am not commenting on the politics of that decision. What I am saying is the financial consequence was seismic. Within 18 months of that event, central bank gold purchases hit their highest levels since 1967. Countries didn't just start buying gold. They started moving gold physically out of Western custody. That is not a trade. That is a divorce. Factor 2. The debt math no longer works. The United States is now carrying $38 trillion in national debt, having raised the debt ceiling to $41.1 trillion in July 2025. The FY 2025 deficit alone came in at $1.8 trillion. And here's the brutal arithmetic. The U.S. government is now spending more on interest payments than on defense, more on debt service than on Medicare. The Congressional Budget Office projects debt will hit 175% of GDP by 2056, or $168 trillion. At some point, foreign creditors run the same math and conclude this debt will never be repaid in real terms. The only exit is inflation. And inflation is a hidden tax on every dollar holder in the world. Why would you hold an asset the issuer is deliberately inflating away? Factor 3. The alternative infrastructure is now real. This is the factor the mainstream media refuses to cover honestly. For years, dollar skeptics said, "What's the alternative?" And they were right. There wasn't a credible one. But in 2025, that argument is dead. BRICS nations are operating the new development bank, which lends in local currencies. BRICS Pay is facilitating cross-border settlements outside SWIFT. India is leading a new payment rail designed specifically to bypass U.S. dollar clearing. Over 40 countries have indicated openness to accepting a BRICS-linked settlement unit. A gold-backed digital currency pilot is live among 11 full-member nations. This is not theoretical. The pipes are being built in real time. And once the pipes exist, the flow shifts. Now here's what I need you to hold on to before we go further. The 3 factors I just described, weaponization, debt math, and alternative infrastructure, these explain why countries are exiting. But they don't explain the timing mechanism that could turn a slow leak into a cascade. For that, you need to understand what happens inside the Treasury market when foreign demand drops below a critical threshold. I'll get to the full cascade in a moment. But first, let me show you exactly how the feedback loop works, because this is the mechanism most financial advisors have never explained to you. The U.S. government issues treasury bonds to finance its deficits. Foreign governments, China, Japan, Saudi Arabia, and roughly 50 others, buy those bonds because it gives them a stable, dollar-denominated store of value, and because holding treasuries has historically been required to participate in global trade. Here is the chain reaction. When foreign demand for treasuries drops, the U.S. Treasury must offer higher yields to attract buyers. When yields rise, the cost of servicing $38 trillion in debt rises. When debt service costs rise, the deficit expands further. When the deficit expands, more treasuries must be issued. When more treasuries flood the market with weakening demand, yields must rise again. This is not a cycle. This is a trapdoor. When yields spike and the dollar weakens simultaneously, which is exactly what happened in April 2025, it signals that the world is not running to dollars in a crisis. It is running away from them. The technical term for this is a confidence break. And in currency markets, confidence breaks are not gradual. They are sudden, disorderly, and brutal. To put a number on the risk, Japan and China together still hold approximately $2.1 trillion in U.S. treasuries. If either nation were to reduce those holdings by just 20% in a compressed time frame, the ripple effects through the treasury market would be immediate and severe. We already saw China instruct its banks to reduce treasury exposure in early 2026. That was reported by Business Insider, sourced to Bloomberg. That is not a rumor. That is happening now. And here is the part that should concern you most. The Federal Reserve's only tool to defend the dollar is to raise interest rates. But raising interest rates when you owe $38 trillion means the debt spiral accelerates. The Fed is holding a fire extinguisher filled with gasoline. Now let me show you exactly what this means for every asset class you own, and I promise you, there is opportunity embedded in this chaos if you know where to look. Here's how the dominoes fall. Watch the sequence carefully, because this is not speculation. This is how currency crises have propagated in Mexico in 1994, in Southeast Asia in 1997, in Argentina in 2001, and in every single historical precedent of reserve currency degradation. This flows first to the bond market. Foreign selling of treasuries pushes yields higher. The 30-year treasury, already yielding over 4.7% as of late 2025, becomes impossible to service alongside a $1.8 trillion annual deficit. The bond market trapdoor opens. Pension funds and insurance companies, which are legally required to hold treasuries, are forced to reprice their entire portfolios. A brutal flush moves through every fixed income asset class simultaneously. Then it flows to equities. Higher yields mean higher discount rates. Higher discount rates mean the present value of every future corporate cash flow drops. The S&P 500, currently priced at a forward P/E ratio of over 20x, gets repriced toward historical norms of 15 to 16x. That repricing is a 20 to 25% correction, not from panic, but from pure math. Tech stocks, which are long-duration assets priced on distant future earnings, get hit hardest. The structural break in tech is not a buying opportunity. It is a reset, and ultimately it flows to everyday Americans. A weaker dollar means import prices rise. The gas you buy, the food you eat, the clothes you wear, all priced globally, cost more in dollar terms. The inflation you thought was beaten comes back harder, not because of domestic money printing this time, because the global purchasing power of your paycheck is declining. That is not recoverable by raising the Fed funds rate. That is a standard of living reduction measured in years, not months. But here's the exciting part. Every single one of these consequences has a mirror image on the other side of the trade. And if you are positioned before the cascade accelerates, not after, not when it's on CNBC, not when your neighbor tells you about it, the opportunity is generational. So if I were starting today with 0 existing positions, building a portfolio specifically designed to protect and grow through a dollar devaluation cycle, here is exactly how I would position. About 30% in physical gold and gold royalty companies. Gold is not a trade. Gold is a measurement of dollar confidence. When dollar confidence breaks, gold does not merely rise. It reprices to reflect the true value of the monetary system. We have already seen gold go from $1,800 to over $3,900 an ounce, a move of more than 115% in under 3 years. The historical precedent from 1971 suggests gold could see another 100% move from here if the current confidence break continues. For direct gold exposure, I like GELD, the SPDR Gold Shares ETF, for liquidity. For leveraged upside, Royal Gold, ticker ARGLD, is a royalty model with zero mining cost exposure. It is the cleanest way to own the move without owning a mining operation. About 25% in commodity-linked assets and energy. When the dollar weakens, every commodity priced in dollars gets an automatic currency tailwind. Oil, copper, silver, agricultural commodities, all of them benefit from dollar dilution. I specifically like silver here. The gold to silver ratio is still historically elevated at around 80-1. In the 1979 to 1980 dollar crisis, that ratio collapsed to 16-1 as silver exploded 700%. The ETF SLV, or physical silver, is your entry point. For Energy XLA, the Energy Select Sector SPDR gives you broad exposure to the energy complex that benefits from both dollar weakness and global energy infrastructure investment, about 20% in non-dollar assets and international equities. If the dollar weakens, foreign assets become worth more in dollar terms automatically. European equities, Japanese exporters, emerging market commodity producers, all of them experience a valuation tailwind purely from the currency translation effect. EAM, the iShares MSCI Emerging Markets ETF, is the broad exposure play. Brazil in particular is a resource-heavy economy that has actively reduced dollar dependency and stands to benefit from both commodity prices and a weaker dollar. The remaining 25% in liquidity, cash or short-term instruments, held in reserve for volatility. The most expensive mistake in a currency crisis is being fully invested when the disorderly phase begins. Keep powder dry. The best entry points come during the panic, not before it. Now let me tell you what not to do, because in this environment, the wrong move is worse than no move. Mistake number 1, buying the dollar dip, because it always bounces. The DXY has bounced after every prior sell-off for 40 years. People are conditioned to that reflex. But a structural break is different from a cyclical sell-off. When the foundation of demand is changing, not just momentum, buying the bounce means you are catching a falling knife with a blindfold on. That's not bravery. That's volunteering to be exit liquidity for the central banks rotating out. Mistake number 2, sitting in long-duration bonds because yields will come back down. Maybe they will. Eventually. But if the confidence break accelerates before the Fed cuts, you will experience 15 to 25% drawdowns in Treasury ETFs like TLT before any recovery. The risk-reward is asymmetric in the wrong direction. Understand what you own before you hold it. Mistake number 3, ignoring this because it hasn't fully hit Main Street yet. Every major currency crisis in history looked manageable from the outside until the day it wasn't. The peso looked stable in November 1994. It collapsed in December. The Thai baht looked stable in June 1997. It collapsed in July. The warning signs are visible months before the break. You are looking at the warning signs right now. The point isn't to make you angry. It's to make you dangerous. Dangerous to the idea that you can afford to be passive about this. Let me summarize the 5 critical points one more time in plain English. The dollar's share of global reserves has hit a 30-year low of 56.3%. The trend has been moving in one direction for 25 years, and it is accelerating. 3 structural forces are driving this. Weaponization of dollar reserves post-2022, a debt spiral that cannot be resolved without inflation, and the emergence of real alternative infrastructure through BRICS. The Treasury feedback loop is the mechanism. When foreign demand drops, yields rise, deficits expand, and more bonds flood a weakening market. The trapdoor is already creaking. The cascade hits bonds first, then equities, then the purchasing power of everyday Americans. The sequence is not random. It is predictable. And the opportunity is in gold, silver, commodities, and non-dollar assets, positioned before the next disorderly phase, not after. The clock on this is not infinite. The window to act ahead of the curve is measured in months, not years. Here is what to do right now. 3 steps. Specific. Actionable. Step 1. Pull up your current portfolio and calculate what percentage is in dollar-denominated bonds or long-duration fixed income. If it's more than 30%, you are overexposed to exactly the risk I described today. Step 2. Open a brokerage account that allows commodity and international ECF access if you don't already have one. GELD, SLV, XLE, EAM, those 4 tickers are your starting research list. Step 3. Do not wait for confirmation from the mainstream media. By the time it's on CNBC, the institutional money is already moved. If you want a real time tracker of dollar confidence signals, treasury demand data, and specific commodity positioning alerts, the membership link is in the pinned comment below. Inside, you get weekly macro briefings, a live watch list of dollar-sensitive assets with entry frameworks, and a private community of serious investors who are positioning ahead of the narrative, not behind it. And subscribe right now, because the next video I'm releasing covers the one asset class that actually thrives in a currency crisis that almost no one is buying yet. You do not want to miss it.